calendar. We're in July, earnings season. Last month, we're pretty much done with the earnings season now. We had Apple report and Amazon reporting in August and September are usually bad months. So in our calendar here, we have two worst months of the year because there's basically no earnings coming out. This is a lot of the traders are on vacation, so we have to make. We don't expect too much, right now at this time of the year. And in the when we look at our stochastics, let's look at this up close. We're still overbought. We're at the top end of the channel, so a lot of times we need a reason for the stock market to go down. And a lot of times a big news story like what came out earlier this week, a downgrade of the U.S. debt, that could cause a stock market to correct down to another oversold territory. But right now, all the tech stocks that we're following, the big tech stocks are overbought, and they're trading more than they're worth. They're trading above their fair value. So so right now we're not expecting too much, and you can't really start buying right now because it's the stock market's pretty extended. The 2-year and 10-year went up this week a lot because if the United States has a lower rating for their bonds, then you have to pay more for that. And this is a very secure investment, U.S. Treasuries. And if they get high enough, then people are going to move out of stocks and into treasuries. So if that happens, then the stock market could go down because of that. All right. Market breadth is going down. So in other words, last week we had 80% of the S&P above the 50-day moving average. Now it's only 65%. So this is going the wrong way in general. So we're losing momentum. So we have a lot of the people there were fear of missing out. They're basically losing their appetite to keep chasing stocks up. So let me see. Okay, so now we have. Okay, in the S&P we have we're halfway. We're halfway between overbought and oversold, and so we have to wait until it goes down basically to the bottom here to where it's a good time to buy for most stocks. Let me see. Oil is going up recently. So the oil stocks and the drug stocks that have been kind of ignored until this time, they're starting to get a bid. So people are getting out of the what's performed the best this year and into some more conservative stocks. And let me see. Right now, fear and greed, we're getting less greedy. I'm guessing towards September, October, we're going to get towards fear. And we need like a pretty decent story for people to be fearful. Right now, there's no real compelling reason for the stock market to go down a lot, other than maybe that downgrade. But we'll find something. Maybe there's another war that happens. But that I'm expecting this to go down to fear in August, September, and that's the time when you start looking to buy things. And if you're invested now, totally invested, or more, if you're invested and you're afraid of it going down, this is the time to take some profits. And because everyone else is still excited, and so dollar index continues to go down. It's since last week it's up a little bit, but it's still in this downward pattern. And all the tech stocks that reported recently have said that the dollar has helped their earnings because the dollar goes down. That helps the multinational companies. Okay, VIX is still at a very low level, and if the stock market goes down in a major way, this VIX goes up. So right now we're still in a people are still excited, and they're not protecting their positions at all. I think for this valuation emotional chart, I'd say we're starting to go down just a little bit, and we're in denial, and we're not at capitulation yet, but we're still greedy. There's still people, are still greedy in our fear greed index. So I think we're still, in this top of this range here. Whenever you get to a point where the stock market's selling off and there's capitulation, it's you have to keep your emotions in check and don't sell things if the fundamentals are still the same. Okay, so now let's look at some of the articles that I picked out. MasterCard had earnings that came out. Every once in a while, I like to check on the earnings and for some of the stocks we're following. Let's see. MasterCard is one of my favorite stocks because it's basically a toll collector, and it doesn't have to deal with people that don't pay their credit card bills. That's the bank's responsibility. All MasterCard does is take a fraction of a percent for every transaction in their network. So what I did was let me see. So one of the biggest catalysts for MasterCard, people are starting to go out and travel, and that whenever people travel, they spend more, and that helps the volume on MasterCard transactions. So what I'm going to do is I'm going to look at their earnings projections. What I do is I look at their annual earnings and estimates. This is a combination of all the analysts out there, and it seems like they're growing around 16% average if you average it out for the next couple of years. So their PE right now is 32. They've always traded at a higher PE ratio. That's probably because you have a straight line of earnings that's very predictable. If this stock ever goes down, to a PEG ratio of 1, that will be a really good time to buy it because it's pretty consistent. I guess if you have some kind of news that comes out that says they have to share their fees with other companies, and that could affect the growth rate. But until then, it seems like they still have a monopoly with Visa for worldwide transactions. So I'm figuring out they have a 32 PE and they're growing at 16%. That means they're 2 times overvalued. That means the PEG ratio is 2. So this is one of my favorite stocks. I've held this for a long time, and Visa is another one of my favorite stocks. They have very similar growth rates and business models. And the big difference between MasterCard, Visa, and American Express and Discover Card is Discover Card and American Express take risks that the customer is not going to pay their bill. And they're consumer oriented. That's why they don't have as much. That's why people pay more of a premium for Visa and MasterCard. Let's see. So looking at the numbers, this is from Yahoo Finance Statistics. Their forward PE is 32. Their PE ratio is the PEG ratio is 1.59. So that's we calculated 2, but they say it's 1.59. So 1.5 times overvalued. But their profit margin is over the top. It's really good, 43, and our minimum is like 10. And return on equity is 172, and that's really much better than the 10 we're looking for. So I'm starting to like investing in companies with high return on equity and high profit margins, and I'm just trusting those companies are going to, over time, add value to shareholders. So let's look at, I already mentioned this. There are 2 remaining AAA rated companies, and one of them is Microsoft and one is J&J. I am really surprised that J&J could continue to be a AAA rated company because of all the talcum powder lawsuits that are pending. And just this week, they dismissed the ability to, J&J had a setback. They're trying to package this lawsuits into a entity so they don't have to go through all these lawsuits, and that was denied. So I'm thinking Johnson & Johnson might have an AA rating pretty soon. But Microsoft, it's amazing the great thing about having a AAA rating for Microsoft is they can borrow at a lower cost than everyone else. So whenever they need to expand and buy a gaming company or something, they could easily tap the debt market and get a better rate on loans, and they can grow faster that way. So and that's another reason why I like Microsoft. And let me see. Okay. So there's an article that came out just yesterday that Amazon had stronger than expected earnings. So they did mention AI throughout their call. They said they're applying AI to a lot of their products, and I think the biggest growth part of Amazon is their cloud, and they mentioned they're adding AI to the cloud. But one thing that Amazon has always traded at a super premium, they have an 80 PE. That is really high for a tech stock, and their PEG ratio, according to Yahoo Finance, is 5. That means they're 5 times overvalued. And Yahoo Finance thinks, hold on, let me do a quick calculation. 80 divided by 5. Yahoo Finance thinks they're growing at 16%, their earnings. So, but I had a different calculation. But their profit margin, look at this. It's like razor thin, like 0.82%. That's not very good. I like to have at least 13 or 10. And then return on equity is only 3. So, looking at their earnings estimates, maybe that's a little better. Look at the earnings estimates. They're scheduled to grow at 35%. I divided the years, 23 to 24. It seems like they're growing at 35% for the next couple of years. So if their PE is 80 and they're growing at 35%, then their PEG ratio is around 2 times overvalued. But they've always traded at a premium. And before, like 5 years ago, and before that, they didn't even have earnings. So they were growing their sales at a really large clip. They were selling a lot, but they weren't making a profit. But in the past 5 years, they've been making profits. So, I think Amazon is up right now. Let's look at the market movers. Run.
Up 10%.
Oh, it's up 10% now? Okay. Okay, the stock market's doing real good today. Okay, Amazon is the best performing stock in the stock market today. It's up 10%. Booking Holdings is up 9%. What's interesting is Expedia crashed just yesterday. So you have like a tale of two cities with Expedia and Booking.com. I mean, there's a theme in that people are getting out and they're going on airplanes. Airplane stocks are doing really good, and Booking Holdings is doing really good today. But let's look at Expedia just for fun. Hold on for a second. I'm trying to adapt to this situation. EX. Okay, so we have Expedia. Let's look at the full screen. They just came out with earnings, and it was not accepted very well. Look, they dropped like 10% just yesterday. From 122, they dropped 20%. Now they're coming back just a little bit. But you had some good news from Booking today. Let's look at, just for fun, let's look at Expedia because I think it has a pretty low PE ratio. Forward PE is 12. PEG ratio is 0.79. So it's should be 20% undervalued. And let's look at,
Why would it now, Will? It would outperforming.
well, the thing is, sometimes stocks go down based on one thing in the earnings report that people don't like. A lot of times, the analysts, the people with the big money, they look at forward projections. Like if Expedia met their earnings, let's see what the news stories. If they met their earnings, but they said they're cautious about if they're going to make money next quarter, then that cautionary forward projections is much more important, and it will go down a lot. Let's look at the earnings projections for this. Expedia, okay. EXPE. Okay, so let's look at the earnings. Its P is 17 according to this one. It's 12 on the other one. Okay. This looks like it's going up in a straight line there. I mean, that's pretty darn good. That looks like 9.55 divided by 11.75. 9.55 divided by 7. That's 20% from this year, from 23 to 24. This year to next year, 11.75 divided by 11, 14. 18%. Okay, so they're going between 15 and 20% their earnings, as according to the analyst. And that kind of, okay, and their PE is 12. That kind of matches, so they're 20% undervalued. But booking holdings, I guess the news is the most important thing. Why did Expedia go down so much? Let's see. Here's news. Okay, Expedia revenue probably disappointed. Potential value trap. Okay, so Sync on its sales, bookings, and outlook came up short. So that outlook is most important. Even if they missed their earnings, if their outlook was good, it wouldn't go down 20%. So that's probably why. Let's look at booking holdings. Because that went up a lot today. That's like a competition. So it went up 9%. Let's look at their statistics. So their PE is 31, and they're fairly valued too. So they have a very similar value. They're around fair value. According to this, it's growing at 21%. No, its PE is 21, so they must be growing around 21%. Let's look at that. Booking holdings. Earnings. So their PE is 27, and that looks like it's growing around 20%. Let's look. It's 140, 40 divided by 165, 15%, 165 divided by 196, 15%. So they're growing around 15% too. So the industry in this business model where you're just an in-between guy selling inventory for the airlines and the hotel companies, and they're just a website that matches buyers and sellers. I think that business model is pretty good because you have a very low cost. You don't have to hire a lot of people. You have computers doing your work for you. They have a so I think these two companies are very related. One went down 20% yesterday, and one shows that the industry is doing good. So I think that Expedia, we can start looking at that for next time maybe to see if that's the only problem with Expedia is reliability. It's a smaller company, so it doesn't have a as reliable, robust means of making money as maybe a Microsoft does.
So
right.
One thing with these like booking companies, I know there's some discussion about AI and like the Chat GPT type stuff, and if you can, plan your trip through some, if Google or Microsoft or some startup can get it, get access to the travel data, right? They can work with the airline companies and stuff.
Yeah.
That you could, have it plan your trip for you, kind of like that, and then book it that way.
Oh.
And that might disrupt the existing. You say like, I want to go from here to there, or like I'm looking for a trip, and like find me the cheapest way to do this. And that is actually maybe a good use case for the large language models, right?
Right.
And so that might disrupt this business, and the existing players may, depending on how fast they react, if they are going to acquire someone, or if they're, one of the big tech companies does that, it might be a disruption to this business, and these the future earnings projections might not be accurate.
Yeah, that's a really good idea. I didn't even think of the Expedia could be, Google went down like 10% the day that they they had a competition with Chat GPT in the works. If Chat GPT could replace a Google, then there goes Google's business model. So that very same thing could have happened with the travel booking sites if their business model is affected by AI. And if you can just say, hey, put together a Jamaican vacation for me, ChatGPT, and then ChatGPT makes, or Microsoft makes the money instead of maybe Expedia. So
and that's very like tempting to me. Like I want to say like, I want to travel like next February, and I want to go to a beach, or I want to go to Cancun, or and just like find me an itinerary that's like cheap, or find me you can imagine that it could really do a good job at that, right?
Yeah.
You almost get like kind of travel agent type services out of it.
Yeah.
And be a lot less of a headache than digging through, Expedia or Kayak or booking, so.
That is a perfect reason for me. If Warren Buffett understood that, he would not invest in this business model because it's easy to disrupt. Warren Buffett would invest in maybe a company that sells razors, because 20 years from now, a company that sells razors is still going to sell razors, unless they have an AI that actually does that for you. But that's the idea, that this is not a robust company or industry, because just like we saw in the pandemic, there are some companies that had a frail business model that fell apart with a little disruption. So that could be the reason why I wouldn't invest in Expedia, even though it's on sale just a little bit.
Yeah, and this has been a hugely profitable industry. Like if you look at Priceline from 1999 to today, it's they have made so much money. So I assume a lot of that was made off of the back of the kind of traditional travel agents kind of going away in a lot of cases. There are still traditional travel agents, but I think that it's a much smaller industry than it was. But yeah, I don't know how Bookings has done, but like last I looked, Priceline, just amazing returns, unbelievable returns.
Yeah, Priceline was actually renamed Booking Holdings. So this was
Priceline. Okay.
Yes.
Okay.
Yeah. So you can see you can see the exponential growth there, and then pandemic. That obviously no one's traveling. But yeah, so that we can keep an eye on these two. This is Booking Holdings is one of the stocks that Ingrid Hendershot watches, and maybe we'll get an update from her in her next newsletter. It seems like a quality company, but I'm not sure if it's as robust as we want for buying and holding 20 years.
Yeah, and so I think that if they can figure out the technology, if they don't, I think that they might be disrupted like they disrupted the agents. So
yeah, I think the other thing to keep in mind is the back end server for all of these websites is owned by Google. So Google acquired a company that basically manages all of the, back end stuff for each of these websites. It's like the underlying database for putting together the buyers and sellers. So maybe Google had that in mind. Maybe their AI. I'm not sure why they did that, but they do own that. But they have to play fair. They have to give everyone equal access to the database.
yeah.
But that's something to keep in mind.
If they've got their AI giving you a way better, experience, and they've got all that data, I used, yeah, I just seemed like that's a perfect, use for this like AI stuff. So.
Right, I agree. That was an excellent idea.
Yeah. Well, I think I need to go. So thank you.
Okay, all right, no problem. Thank you very much for attending. I know people have to go now, but I'm going to finish this in case anyone has some extra time. I know we're over time, but because I got a late start. Okay, the other thing is Apple came out with their earnings. They had declining earnings year over year. If you look at their earnings from last year to this year, they're going down, but they're still projected at 9% growth for the next couple of years, the next couple of quarters. So I did the calculations on that. They're only growing at 9%, and their PE is 32, so they're way overvalued. They're 3.5 times overvalued, and they went down 3% on that earnings report. So I'm buying it because I know over time they're going to grow around a total return of around 10% for me. But right now they're super overvalued. It's not a good time to buy them. But one thing that's good is their services are growing. They have millions of I think billions, 2 billion daily active users of their installed base. So if they can sell services to them, which is growing over time, that doesn't cost them a whole lot of money, and that's a really good way to make money, I think, consistently. And the only other thing I wanted to show was the sector ETFs, the things that are going up and down now. The things going up the most are telecom, miners, and homeowners. Oil, home builders. Okay, those are going up the most, and the ones going down the most are the more conservative stocks, the consumer staples, utilities. I guess because, let me see, I'm not sure why that is. Let's look at some of the market movers. We've seen this before. Amazon, Booking. Let's see. We see a lot of the antivirus companies in the top 10 on the lower part of things. Apple is down 3.7%. They ran up. They were at an all-time high recently. So they're just, they didn't meet expectations. So anything close to not meeting expectations, they're going to sell off a little bit. And a lot of the drug companies are doing good today. We had some stocks that have high dividends and are in the top 10. Let's look at some of the NASDAQ stocks. Let's see. This is the company that does Jira. So I think that that's a very small company, so we can't really count that, track it. Amazon's doing good, and Amgen we're following. A couple high PE stocks here. We have Fortinet. A lot of the antivirus companies are in the top 10. Zscaler, CrowdStrike, Palo Alto. So they're all high PE stocks. You see the ones doing good. Apple, Caterpillar. Okay. Can't really say much about that. Microsoft. All right, so we have a market rally today. It's going up a little bit. Let's look at the S&P right now as we speak. Okay. So we are overextended in the stock market. People are buying, so and we're in a bad time of the year. So it looks like some of the leaders of the stock market are not doing so good. Like Tesla is going down. We have Apple going down. So a lot of times the stock market follows, the leaders. I don't know. We're overextended, and we had a good earnings report by Amazon that could have helped the stock market lots. We'll see, but right now we're overextended in the stochastics. If we look at our stochastics, you can see we're at the top end of our channel, and we're going down in stochastics. We're like 50 right now, 59. So it's only under 20 that it's time to buy, and it's let me see, what else do we have here? I think that's all that I have to say for today. Thank you so much for attending, and I hope you have a good weekend and a good stock market week next week.
Thank you,
Thank
Greg.
you. Thank you, Greg.
Have a good weekend.
All right, thanks. You too. See you next